One of the biggest misconceptions in childcare center acquisitions is that buyers only need enough money for the SBA down payment. In reality, that is usually just the beginning. I'm Brent Delhamer with Childcare Insight. And this misunderstanding creates major problems during underwriting and escrow. A lot of first-time buyers entering the market thinking something like, if I can come up with 10% down, I should be fine. Then the lender starts reviewing liquidity, working capital, post-close reserves, operational stability, and transition risk. Suddenly the numbers feel very different. And this is where many buyers get blindsided. In many SBA-backed childcare acquisitions, the lender is not just evaluating whether the buyer can technically close the transaction. They're evaluating whether the buyer can realistically survive after closing while operating the business responsibly. That distinction matters enormously. Childcare centers are operationally intensive businesses. Payroll is constant, staffing ratios matter every day, enrollment fluctuates, licensing compliance matters continuously. Unexpected repairs happen, families leave unexpectedly, teachers resign unexpectedly, and lenders know this. That is why many lenders become nervous when buyers are trying to deploy nearly every available dollar simply to reach the closing table. I recently saw a situation where a buyer technically had enough funds for the required equity injection, but very little financial cushion afterwards. The business itself was reasonably stable, but the lender became concerned about the post-close operating reserves if enrollment softened or staffing costs increased unexpectedly during transition. The buyer viewed the down payment as the finish line. The lender viewed it as the starting point. And there is another issue many don't talk about. Many buyers underestimate how much cash gets consumed outside the actual purchase price. Escrow deposits, lender fees, legal reviews, licensing costs, inspections, working capital, payroll timing, insurance deposits, and operational reserves can all quickly add up during a transaction, especially in childcare. I have seen buyers focus heavily on the purchase price itself while underestimating the liquidity required to comfortably operate the center during the first several months after close of escrow. In many cases, lenders are evaluating whether the buyer has enough breathing room operationally if the transaction period becomes bumpier than expected. That often influences underwriting confidence significantly. Another major factor is how lenders evaluate the source of funds. In many transactions, buyers assume all cash is viewed equally. Typically, lenders look carefully at the equity injection and where it's coming from. Savings, investment accounts, retirement funds, gifts, outside investors, or borrowed funds can all create different underwriting conversations, depending on how the deal is structured. And this can create delays during escrow if documentation is incomplete or unclear. I worked on a transaction where the buyer had assembled enough capital overall, but because portions of the funds were moving between multiple accounts and sources, the lender required substantially more documentation than the buyer anticipated. The transaction itself remained viable, but escrow became slower and more stressful than expected. And this creates another important issue. Buyers often focus too heavily on the minimum required down payment instead of overall financial positioning. Sophisticated buyers usually understand that stronger liquidity often creates stronger negotiating flexibility. Sellers become more comfortable, lenders become more comfortable, escrow tends to feel more stable operationally. The strongest buyers are rarely the buyers stretching every dollar as tightly as possible. Now, that does not mean that buyers need unlimited liquidity. But in many cases, lenders want to see that the buyer can absorb normal operation volatility without immediately destabilizing the business after closing, especially if the center already has some pressure points such as elevated payroll, fluctuating enrollment, deferred maintenance, or lease negotiations still underway. And the crazy part is that many buyers do not realize how emotionally stressful acquisitions become when financial cushion is too thin. Every unexpected repair, staffing issue, or enrollment fluctuation suddenly feels magnified. That pressure affects decision making. This becomes especially important because SBA underwriting often continues evolving during escrow. Updated financials, enrollment trends, staffing changes, or lease adjustment, they can all affect lender comfort later in the process. Financial flexibility matters more than many first-time buyers expect. So, your homework? It's simple. Before pursuing a childcare acquisition aggressively, calculate not only your projected down payment, but also your expected post-close reserves, operating cushion, and working capital comfort level. Then ask yourself honestly whether the business would still feel manageable if operations temporarily became more difficult during the first 6 months after closing. That question alone changes how many buyers approach acquisitions. If you want a confidential discussion about your child care center acquisitions, valuations, or transaction structure, reach out to us today at childcareinsight.com.